Good evening, everybody. We'll be starting the webinar in about 5 minutes' time, so thank you for joining. We've already got a great attendance and more of you joining all the time, so 5 more minutes and I'll be back on. Well, good evening, everybody. Hope you're all well. Just give me a quick raise of hands if you can hear my voice. Thank you. Hello, Irina. How are you? Hello, Mark. Hope you're both well. Sonal, Jim. Hi, Mike. Michael. Another Mike. Oh, lots of you. Great, you can all hear me. So where is everybody from today? Just give me an idea whereabouts in the world you are. See who's the furthest away. Well, we'll just wait for the last few to come. Oh, I'm near Guildford. Hertfordshire. Lovely. Right, we'll just wait a few minutes because there's quite a steady stream of people coming on now. So we all had a good day today. Ours has been pretty hectic. We've got another exchange. It was due to happen today, but it'll happen first thing in the morning on a nice commercial conversion, and just waiting to sell one and to purchase another one, which should legal completion tomorrow night. So all rather busy. How'd you go, Deb? So for everybody who's on, if you'd just like to say something in the question box, where are you from for a start? Hello, Lee. Good to see you. Kettering. Got Northfleet, Kent. How'd you go, Deb? Hi, Mark, Irina, Andy, Andrew. Good evening to you. Another Mark, Philip, Sonal. Great. Well, look, I think we've got most of you on now. So, yeah, I'll make a start. So I don't know how many of you have been on a webinar with me. I tend not to do normal webinars. I'm not going to take you through loads and not going to do a big sell. So I'm just going to try and pack this full of as much content as I can in around about an hour and a half. So we'll aim to finish around about 9:30. I like to get into the detail, into the nitty gritty. So I'm going to give it my best shot and really give you as much as I can. We have, the only thing I have, only do one course. It's a 2-day masterclass. So I'll mention a few points on that right towards the end, around about 9:20 for those of you who are interested. So I'm not going to waste your evening with lots of slides on selling of courses and things. So hopefully this is for you. You know, whatever you want to take from it, whether you want to take action, whether you're already taking action in commercial conversions and developments, there'll be some nuggets here which I really hope will help drive you forward quicker. Great. Right, so to me it starts before commercial conversions, and it starts with redefining your path, the path you're on at the moment. Okay, I like to look at 12 months time, look at a reasonable period of time ahead of you. And for most of you, I think the key question is always to ask, is commercial conversions, is it a vehicle or is it the goal itself? Now, I think as much as I really enjoy and I'm very passionate and have been for many years on commercial conversions and developments, it's not a life passion. Okay, so it's a passion that gets me to where I need to go. So it becomes a vehicle to get to my passion. So that's a point to question for yourself. Are commercial conversions something that will take you towards your goal, or are they the goal itself? And depending on what decision you make, those next 12 months are going to be shaped in a very different way. If you look at where you were 6 months ago, so here we are in October, wind the clock back to April time and think how short a period of time that was. Now wind the clock forward 6 months from October onwards, you know, that'll be March, April time. Again, it's a flash in the pan. So all the time in commercial conversions, it's about taking your time, building the credibility, the foundation stones, the stepping stones that will take you to a greater level a lot quicker. So don't aim to be trying to get something in the next week, next fortnight. You know, it won't happen that quickly for most of us. It will happen in periodic steps, but you're rapidly building on top of cementitious foundations. So these are the type of decisions that if you make correctly, you'll create that impact, the momentum, cash flow, capital, probably both. You'll build on the experience that you need to do more and more commercial conversions, so you're doing them really regularly. We're doing generally about one a month at the moment. Won't always be at that level, but it's quite frenetic at the moment. You'll build on the systems that you require. You'll build on and capitalize on the leverage that your network and your supply chain, your professional team will enable you to develop a lot quicker. So that redefining that path, you know, this is a vehicle that is going to serve you for many years, possibly decades into the future. So treat it as that. Treat these formative few months as your investment stepping stones. It's all about enablement. If you want to create the impact, you have to create the enablement first of all. And this is about high performance business mindset. I've run businesses around the world for the best part of 26, 27 years before I retired from corporate life 2 years ago. And these 6 or 7 elements here, I believe, are absolutely pivotal for unlocking the value in any developments and commercial conversions of one description or another that you might undertake. First of all, pretty much every single one of them are going to be done in a special purpose vehicle, and I'll go into that in a little bit more detail later on. So it's a business. A special purpose vehicle is a special business set up entirely for one purpose, and that is to serve that particular development. So you're going to need a high degree of business acumen. Now that can be acquired, that can be learned quite straightforwardly, but you do need it. And quite often I see people rush towards commercial conversions, developments, all the emotion, and actually forget that this is a business and there are serious fiduciary responsibilities as a director or as a partner if it's an LLP within this business. So if you've got the business acumen right and you combine that with solid hard work and smart work, then you'll create that abundance. The cash flow will follow, and that's also a consideration in commercial conversions. Looking at the risk versus return, we call it risk-adjusted returns, and I'll come on to that shortly. But you've always got to balance the propensity to risk with returns. The fundability of the projects, generally that's going to come in the terms of senior debt, stretched senior debt, and mezzanine, but institutional finance on one side of the camp, and then also your private capital, which could be brought to bear in any number of ways, through loans or through equity structures. And then finally, but last but not least, leverage. What commercial conversions gives us is to be greater than the sum of the parts. We have the ability to leverage professional teams who can bring to bear professional indemnity insurance, huge amounts of credibility, massive swathes of knowledge, compliance, which will enable us to move quicker, faster, in a more assured manner that will not only give us confidence and allow us to sleep at night, but also enable our fellow stakeholders, that could be the funders in whichever capacity, to be able to enable us to be eminently fundable. Just check everybody can hear me. Can you just give me a quick raise of hands, please? Lovely. Thank you. Oh, got quite a few more. Come on. Hello, Wayne, Tobin, Sonal, Wazim, Philip. So your property strategy could be any number of these. It could be a mix. We have some buy-to-lets. We've got service accommodation. We've got a whole tranche of HMOs in our personal portfolios and also in the company. But it's commercial conversions and large land developments. That's what our primary interest is. And as you can see on the left, the higher you go up that pyramid, the greater risk there potentially is. There are also the greater returns as well. Each one of those developments requires a greater level of time and also increased levels of expertise. Now we can argue till the cows come home in what proportion, but I think we'd all agree that's generally the draw towards. Now from our perspective, we need to manage those risks and we need to access those returns in an assured manner. But what we love about commercial conversions and developments is commercial finance. Commercial finance makes our cargo quicker, to quote the old phrase. Commercial finance will enable us to acquire the project, will enable us to develop the project there. For sure, we'll need to bring additional capital to bear, but it's a very flexible, very agile tool, and that is probably our predominant leverage that we utilise. But also bring to bear private capital. We do invest very heavily, myself and my business partners, in our developments, and indeed also in other parties' businesses. But private capital combined with commercial finance at a scale enables developments and commercial conversions to move swiftly and artfully forward, very tenaciously. But I just want to give you one piece of advice. Bringing private capital to bear, and indeed commercial finance, always approach it as though you're creating shared value. You can't fake shared value. You either want it or you don't want it. Okay, with us, it's within our DNA. We've always wanted to create that shared value, and that's hugely important. So what I'm trying to say here is, when you're bringing private capital in particular, it comes with an enormous amount of responsibility and duty of care. What I'm not an advocate is the term of no money down. Okay, it's a ridiculous statement. Everything costs money. It might not be your money, but it's somebody's money. And I think it's very disrespectful to use the phrase no money down. So my suggestion is treat that with a duty of care as you would your own funds. Okay, it's all about separation, segregation and risk, but your private investor certainly does not want to hear the term no money down. Their money has an awful lot of respect. And for us, the biggest key performance indicator in our business is return on time invested, or return on time employed. You may have heard that term before. Okay, with commercial conversions, the numbers are larger, the scale are larger, the leverage is larger, the returns are larger, and the timescales are not that much longer. A typical construction period, refurbishment period on one of our commercial conversions will be somewhere between 6 to 12 months, really 7 to 12 months, and an SPV duration would be, approaching 15 to 24 months. So these aren't long periods of time. And if you compare those to some of those other strategies, you'll be able to unlock the huge swathes of returns for you and other stakeholders very quickly. So this is a matrix, a step of systems that work for us. What I don't advocate is the 3 steps to earning £1 million in a fortnight. Okay, I'm a bit too long enough in the tooth, over 26 years of corporate life in 4 continents and 33 countries, to want to be in this game just to sell courses and have jargon. However, there are simple steps to follow. It's not easy, but the simplicity of the steps, if you've got the right team on board and you've got the right humility to accept that you need other people there, and indeed bringing other people along will be part of your assurance process in the eyes of the financial community. The banking fraternity can be incredibly useful. So without a doubt, it will always start with your mental preparation, your personal strategy. Is commercial conversions right for you? But once you're into commercial conversions, there are 10 core areas that I'd like you to focus on, and we're going to touch on each one of these throughout this evening. So we'll just skip through these quickly so you can get an appreciation. So firstly, finding the opportunities that are out there, and they are out there. Very regularly we're finding them. So you just got to know where to look and invest in the right places over a lengthy period of time. Then the due diligence. The due diligence must be bank grade due diligence. You must learn how to undertake your due diligence at a bank grade level. Because hey, guess what? The phenomenon that is going to make your development happen generally is going to be the bank. And they're going to be doing bank grade due diligence. So you better do the same level of DD as the bank do. Otherwise, you're going to be having quite substantial abortive costs when the bank pulls out of the deal and leaves you at the altar or close to. So we advocate doing a lot of due diligence very quickly in a very concerted period of time before we start expending any valuable seed capital. There's the planning, how we structure planning, whether that be through permitted development, whether it be through conditional offers. We make our money generally how we structure the offer as we go in. We always have the end in mind, but we make our money on how we articulate and structure and negotiate moving into a deal. The valuation process, quite often this is just blurred within due diligence or within funding. The whole approach towards valuation is incredibly important. Funding, we can split funding down into a number of areas. Generally that's going to be the institutional funding, and it's also going to be the private capital that's brought to bear. The overall economics of the development and the contextualization of the market that we're serving, again, needs a huge amount of focus, and increasingly government putting pressure on organisations to prepare proper structured business plans, not just development analysers, to structure their business, even though it might be an SPV. So we can expect to see this structuring a lot more effective in the future from a due diligence bank point of view. The completion phase, and I'm talking about getting to the start line here, talking about actually acquiring the property and then making a start on your conversion project. So we're going to look at the 4 different steps that are entailed in doing that, and that could be an incredibly fraught process. So you want to alleviate as much pressure by good quality planning and systems, and I'll take you through 4 areas of that. As I mentioned before, we're going to be operating this as a business. Okay, we're going to be directors, shareholders. There may well be other shareholders and directors coming in from our private investors. So we're running this as a business. It needs to be undertaken with the due diligence and probity as any business would, with the right level of acumen, support and counsel around us. And there's the construction, the refurbishment phase, and then there's the exits. Now, whether you choose to start at the finding part of that system, or indeed starting at the exit, start with the end in mind, looking at what you actually want out of this, your strategy, your exits, and then define what that exit looks like, and then go out and acquiring suitable property. So you can argue whether you start at the exit or start at the finding, but inevitably it needs to be a core part of your strategy. So that, we refer to that as our economic equation. Call it a system if you like. To us it's an economic equation which has 2 measurable parts. It has risk and it has returns. And how we refer to that is risk-adjusted returns. That's something that's seasoned over many years, decades, nearly 3 decades in business life for me. And you must ensure that you don't just look at clean, neat line returns. You need to look at the risk-adjusted returns, which will look at the probability of various events happening. So as you can see, my language is very much a business management language. Not emotional, not fist pump, rah, rah, rah. Okay, we'd need to be very level-headed. There will be challenges along the way, but if we've got the right systems, structure and processes, we'll work very hard on these developments, but we'll also have a system and a structure that works very hard, so we're highly tax efficient, as an example, in how we operate these. So who are we? Who am I? I know many of the names, I know many of you on this webinar, but not everybody. So just by introduction, my 3 other business partners, Nigel Green. Nigel's spent 31 years in the construction industry, been involved in some of the largest projects around, up to 100 million as project director, been involved in operational capacities. His background is commercial project management, project directorship and building services. So he's worked around Europe, Middle East and Africa. Phil Burr spent 33 years as a commercial director, running, again, very large programs, tens if not hundreds of millions of capital spend. Mike Tivy has run numerous businesses and divisions within a PLC in startup mode, up to 400 million in turnover. And myself, I've run about 3 million square feet of global infrastructure rollout over the last 25 years, projects varying from 50 million to 1.5 billion US dollars. So we've not seen everything, but we've been around the block a few times. And as they say, every scar has a value, and we pride ourselves in any mistakes that we may have made. We've endeavoured not to make them twice, and we've learned from them. So it's very much a fail forward. So these are some of the projects. Top right, that was Lock and Dam 16 in Muscatine, Iowa on the Mississippi. The winter of '92, that was my first ever joint venture. I was one of the project managers on a joint venture between the contractor I worked for at the time and the US Army Corps of Engineers. That was interesting at about -30. Right the way through to building brand new data centers, which were done on acquired, design, finance and operate basis, large pan-European and pan-Asia Pacific networks. You can see a lot of high voltage switchgear. So attention to detail. There's a lot of risk to life and property potential, and we are risk managers. That is what we're good at. That's what we've done for 25 years, planning through the detail, being paranoid, being cynical, being level-headed, not being hyper-emotional, staying calm under pressure. And hopefully you'll see that in some of our processes, systems and approach that I'll take you through this evening. These are some of our developments. Some of these are more the smaller end. They generally go from about 6 apartments, depending on the area, through to about 50 apartments, although we have got quite a few on the drawing board at the moment that are in the 70, 80, 90 units. So generally they're commercial conversions and land developments. We do take planning risk in a very balanced, very specific way from time to time, but generally taking planning risk is something that we absorb in the structuring on the way into the contract through conditional contracts negotiations. So here's some examples of some of the developments that we've been through. This one, Wright Street, 8,600 square feet. It's grade B 1A office, but it wasn't available for permitted development. And why not? Because it was grade 2 listed. So we took an option on this. In fact, no, we didn't. We took a conditional contract with a long stop of 12 months in which we secured planning, full planning permission for 18 beautifully appointed apartments. So that's a CGI there. So Jagoda, I'm not too sure whether you think of that CGI. I know that's your area of expertise, and maybe we will have that question on how you can maybe help us in the future as we continue to strive to improve the visualization of that product to the market. So we structured this one. We actually bought this in our SaaS. Now can I just have a quick show of hands? Who's interested in it? Sorry, who's had a SaaS or has operated a SaaS at the moment? Okay, 1, 2, 3. Okay, so not many. So the final, I refer to it as the cutting of the umbilical cord of corporate life, was to reclaim our pensions. But being still a very young 48 years old, I'm still seven years away from being able to access any of my pension in a tax efficient manner. So we have basically taken our corporate pensions, Nigel and I, and put them into a SaaS. We acquired this development in a SaaS, held it, and we're in the process over the next, it'll probably either be tomorrow afternoon or Monday, where we will complete on the purchase from our SPV of Wright Street from the SaaS, which will produce liquidity back into the SaaS, and we'll be out shopping for some more commercial long-term hold property, and the contractor will move in and start developing this within our SPV. So a very harmonious, I call it a double compound curve here, where we're not only creating phenomenal growth curve within our SaaS, but what the SaaS is doing is actually directly enabling our SPVs as well. So we're getting that double compound curve momentum. That's smart thinking, and I've learned that from having high quality mentors over the years, not taking any chances that I might know it, but actually going to people who are actually doing this. So if you want to know a little bit more about managing SaaS, write down SaaS Investor Group, SSAS Investor Group. I've set that particularly up on Facebook. It's totally complimentary. Apply and I'll approve your entry. I think we've got almost 250 members in there now, and they're people who are constructively just talking about SaaS. And why have I set that up? Well, we want to be a black belt in it, because having a SaaS or accessing people who might have a SaaS can be an incredibly, phenomenally important part, very catalytic in any strategy that you have. But if you're not a black belt and you've got a desire we have to be black belts, well, come along for the ride. Come along, enjoy it with us. We'll share, we'll collaborate, because at the end of the day, we're only in competition with what we're capable of. Okay, so the open hand is the strongest grip, as they say. So come and join us. So that's Right Street. GDV of just over 2 million. Purchasing that for $500,000, refurb costs about 820. So you can see there's a very healthy profit margin there after funding costs, etc. So look, we're really passionate about this. Nice profit there, lovely project. This one's based up in Hull. We've got another one in Nantwich. The majority of our other developments tend to be in the home counties, because generally that's where we live. We left corporate life after 26 years. I've got 4 children, and I wanted to spend more time with my children, not on the M1 or the M40, to be honest. So, you know, that was really a very key determining factor. And once you get over the mindset shrinkage of there is a shortage of capital out there, and understand there is just so much capital. In the last 3 days, I spoke to various parties who have 24 million available to invest in our developments and other parties' developments. Okay, now I've been doing this a long time, but if you're prepared to put the hours in, the time, and protecting your reputation ruthlessly and living life to your values, that's the kind of accessibility to capital. Therefore, you'll fear not which area you go to, because if the deal stacks up, the funding will be available, subject to certain criteria. So why do we do this? Okay, is it materiality? Well, I've got 4 kids. The last thing I want is a Ferrari or a Lamborghini. I don't really get sparked up by those, I've got to be honest. I can't get 4 kids and a dog in them. I am an engineer, so a nice Patek Philippe chronograph, yeah, lovely, I can appreciate that. So materiality may be something that engages with you. But for me, it's about my time. My time is so important. This is a scene from a local railway station, and you can see not only are people crowded past the yellow lines to get on the train, they are like lemmings. They actually know exactly where the train station doors open. They know which crack on the pavement they need to stand every morning, and they jostle for that position and wait for those doors to open. And just raise your hand if you've been one of those people. I know I have in the past, who have actually been there, jostling there. Hello Rob, hello Tom, Tobin. Yeah, there's half a dozen of you. Hi Caroline, hi Kaz. So lots of you put your hands up there, and you know that's the fateful position, and I vowed I would never be there again. And you know, it's the relationships that are absolutely key to me. That's my 4 children. As an engineer, obviously, I have to line them up and put a ruler across them, make sure they're in a straight line. I think that's about 18 degrees. But lovely kids, really proud of them, and I want to spend more time with them. So that return on time invested is absolutely crucial. But also to provide a contribution back to society. And I think many of you know some of the work I'm doing with what I'm setting up as part of my foundation, which is a young entrepreneur. So that's been working on that for a year now, and I'll come on to that shortly. So ultimately, if you can provide the type of network, the type of structure, the type of passion there, it comes down to living a life of choices. I think you'd agree. So life for me now, I retired 2.5 years ago. Love my family life. I work from home. My choices are I work with who I want, where I want, and with what and where I want. Now that might sound arrogant, and it's not every minute of every day I enjoy what I do, but overall I love what we put in. I love how we change people's lives, how we affect the stakeholders, And when you've got that passion, the word retirement just doesn't exist. I don't know what I'd retire from, to be honest. I might scale back my time in certain areas, but for me it would be about passing the baton to our younger generation who are already starting to come in as part of our succession plan. So we started our succession plan on day one when we set the business up. That's how long-term and multi-generational our focus is. So one of our ex-prime ministers, Benjamin Disraeli, one of his famous quotes, "What we anticipate seldom occurs, and what we least expect generally happens." So I think you can appreciate from that model that there is no reason why you can't anticipate the problems. If you can anticipate, you can deal with them. But if the ignorance is there and you choose not to access the information, it's going to be pretty painful. And the analogy I use here is walking across a lounge, a stranger's lounge in darkness. You know there's a coffee table there. You know you're going to hit your shin on it. You're going to be very tentative and very short steps, where turn the light on, illuminate the runway and stroll right through. Avoid the obstacles. Okay, so it's obvious when you put it in simplistic terms. But Benjamin Disraeli, way back when, he does look a bit miserable, I have to say. I don't think I'd like to go to his Christmas party, but certainly wise words. So there's our values, and we put these values directly into our developments, and they're hugely important. Our systems, our strategy, the people behind it, and creating shared value. And that's our ecosystem that we use every day and have done for well, we've all been directors of the same company in corporate life since 2002. So it's been a long time in the making. And these are our values, that creating shared value. Who are our stakeholders? I mentioned our stakeholders earlier on. Well, they're every party. Okay, if you can look through the right end of the telescope and look where value can be placed, where you're creating value, whether that be with the vendor, contractors, tenants, agents. I'll assume you can read, I mean, you can go around there. The local authority, the planning department, they're a stakeholder. They're custodians of our community. Let's treat them with respect. They can be painful and it can be challenging, we know that. But this is about a shift in mindset where each of our developments does create an enormous potential, realised potential. And we unlock that benefit. This is what's great about commercial conversions. Okay, it's not just about providing homes. We're providing our professional teams with enormous sums of funding to go on and plough that back into their teams, R&D, development. Okay, our funders, ourselves as individuals, ourselves as our team. So you really get the impression of our values in EquaGroup. So it starts with the pipelining. There are really two pipelines, funding and there's deals. Now in funding, that could be through our equity investors, private capital, and in some cases a bit off-piste, such as vendor finance, deferrals and the like, but also in the deal structuring through commercial conversions, long-term commercial holds as well, mixed-use developments and land developments. So how do we find these developments? Okay, a lot of people come to me, you know, whether it be in the masterclass or whatever, they'll come to me and say, look, we're really struggling here to get developments. And we granularly go down and look at what methods can they have. Now, I could list you probably 20, 30, 40 different methods, but the reality is it's going to be the 80-20 rule. There are going to be a few where you'll get the most return on your time. And it's time you're going to have to invest in these relationships. So here's the first 8. I've put commercial agents there, right at the top of the list. Commercial agents give us the greatest return on investment, without a doubt, bar none. We very rarely, occasionally we do, but rarely do we look at on-market developments. Generally, they're off-market developments. We've put in enough time over the months and years with our commercial agents that they know us, they know our pedigree, they like the way we do our business, they like our values. And ultimately, you have to look at what a commercial agent is. Okay, commercial agent is a business model. as well as an individual who wants to take food home for the family at night. They have a fixed overhead and they have a variable income. So they will be backing the party who can best deliver the best price with certainty and deliver it to the altar. The worst case for them, and obviously their client, is that they're jilted at the altar and have to start the remarketing process all over again. So commercial agents, my biggest recommendation to you is get your commercial agents, highlight them in your local area, go and see them, and that's an art in itself, but learn how to approach them and invest time and effort in showing them that you understand the due diligence required to do a development. I'll still drink of water. Private contacts. Let it be known what you do. You know, speak with passion, be authentic and genuine. Many people I know have come to me just out of the blue and said, "Oh, I've been watching what you've been doing for a while, and you know, we've got a commercial unit, or a friend of mine's, you know, selling his business and he's got a commercial property there." So that has a high return for us. Equally, whenever we do a development, we want to understand the vendor structure behind it, because what has one person who's got a commercial property probably got more of? Yeah, two things actually: more commercial property and funds. Auction. It's interesting. Stuart, one of my mentees, he's just been successful in an auction this afternoon. So well done, Stuart. I'm not sure whether you've actually made it onto the webinar or not, but just fantastic news. So auctions can be good, can be a bit hit and miss. Certainly can be a lot of pressure there. And there are a few others there. We tend not to spend much time on Rightmove and Zoopla, although there can be opportunity there, because remember, you're only competing with what you're capable of. And I'll give you a little bit of a story here. We bid on a property in Reading quite some time ago, and it was offers over 3 million, and we put our offer went in at 4.4 million, and the offer that was accepted was 5.5 million. Now you may roll your eyes and say, blimey, somebody overbid for that. But our strategy was to intensify PD, but keep within the existing envelope of the building. The strategy of the party that outbid us by 1.1 million and secured the property, they were going to buy the whole development in cash, in retained profits in their business, and they were going to sit on that development for as long as it took, probably 2 years, to put 3 to 5 stories extra on that building. So I had no hope. We had no hope of competing with that. They were always going to outbid us as long as they could be credible. So you're only competing with what you're capable of. Don't get hyped up with what other people are doing, quite frankly. You know, it's always greener in somebody else's garden. Just ignore that. Play your own game. Learn from others, absolutely, but don't try and compete against them. That can be fatal. Other areas, websites, florets, Daltons, knowing your area. Famous story now, you've probably heard it. Oak House in Colchester, 16 apartments. My business partner, Nigel Green, went to have his haircut in Colchester, and on his way from the car park to the hairdressers, to the barbers, he saw a gentleman on some step ladders screwing in the signboard. He stopped, had a chat. The guy told him that the building was going on the market in the morning. Nige put a quick call into the agent, said, "I'm going to have my hair cut, can I have a look at the building when I come out?" An hour later, walked into that building. 3 hours later, we secured that building. Okay, and in that 3 hours, our first offer was not accepted. So we can work very quickly with significant amount of due diligence, and you can too. Okay, a lot of this can be systemized, particularly if you're working in the same area quite a lot. You'll get used to your numbers. So that was a very successful property, and we've also secured private investment and potentially another deal, possibly 2 other deals actually, just out of that one transaction. We tend not to use sourcing agents too much, primarily because actually we don't trust anybody else's due diligence. we can't attach any assurance to it whatsoever. So quite frankly, we only trust our due diligence. That might sound arrogant, but the duty of care I have to my funders, all my stakeholders and my private investors comes first and foremost. So it just happens that sources haven't provided us with developments that are appealing to us or complete in any form of due diligence. Airspace is another interesting opportunity. We've got one at the moment in Essex where we're looking at putting another floor on a building. If you look at the row of ridge tiles along, ours is a lower building. Now clearly that's going to require planning, but we're looking at a phased step there with the vendor and with the commercial agent on going to pre-app and then planning. So we're protecting ourselves against majority risk all the time. So as you can see, in the great words of Jim Rohn, don't wish it were easier, wish you were better. Every day, every week, every month, we learn something new. We finally hone, we fine-tune our development analyzer. We think it's probably one of the most advanced around. It's probably in about version number 23 at the moment. It's taken years to advance to that level, and I can guarantee you in a year's time it will be on further revisions, because the world just doesn't stop going round. Okay, there are always going to be changes, always evolution, and always learning. So remain humble. So we're always looking at forcing appreciation into our properties, and these are just some areas of appreciation that we can force in. So obviously securing at the right price, delaying and conditional optionality on the contract, change of use, planning, permitted development rights, intensifying existing PD. That's a great strategy. We're doing a lot of that at the moment. And obviously with a commercial property, which is probably valued at net internal area, and we can extract a lot of potential out of the gross internal area. So we're looking at high utilization factor intensities there. Now the beauty of those 5, before we come into build and new home premium and the like, is that they all happen before we acquire the property. So would it be a great idea to force that appreciation in at somebody else's risk rather than ours? And that's what we do. And our strategy is to decrease risk and increase profits over that time. So hopefully you're hearing me loud and clear. It's about how you go into the deal, how you structure it, how you protect your downside, optimize your upside. And this is a few points on the secure entry. Your commercial agent is going to be absolutely valuable, a mine of information. They want the same thing. They want the building sold. They might have a different way of going about it and trying to please different people. They clearly have their clients' best interests at heart, but they will listen to reason. Now what I find, and you'll probably recognize this from Facebook, you'll recognize a sense of entitlement that comes across in some of the Facebook rants and things that I'll just roll my eyes sometimes, where people have said, do you know what, I've put an offer in and the agent won't put my offer forward to the vendor. You know, shock, horror, and you know, I'm having a right go at them. Do I take them to the ombudsman? You know, at the end of the day, there's many different ways of putting an offer forward. I can say, we have a very fine offer here from an organisation clearly with a lot of capacity and capability. Or I could say to the vendor, and you might want to consider this, don't really know these guys, but you know, they've just put a bid in out of the blue. You know, 2 different ways of presenting the same bid from an agent to the vendor. So work with your agent. If your agent isn't prepared to put a bid forward, then ask him why. And we use transparency. Okay, back to that collaboration. We have never had an abuse of the confidence that we've put in an agent thrown back at us. And I mean that. Okay, we sit down with the agents and we go through pretty much every time our development analyzer, and it is complex, but it's easy to use, and we show them every element that we've done. Okay, and we want them to verify, looking at the cost per foot to purchase, the cost per foot for fit out, all the fees, the GDV, the local market area, all that information. We ask them to verify it, and they'll nod, and we'll ask them to verify what our profitability would look like. Would they think that was reasonable for a developer? And so they can see that through logic, reason and due diligence, that is how we've arrived at their offer. Now the clever bit here is what we're doing is we're laying a path, an audit trail. So if any one of those elements changes in the due diligence period, we've got a point of contextual reference to go back to say, you know how we came to our £1 million offer. However, you've now seen that there's, I don't know, £100,000 of asbestos that has appeared in the building that nobody was aware of. So clearly one of these dynamics has altered, so it gives us a basis to renegotiate. Now we're very ethical, we don't use that unnecessarily, it's only at the point of necessity, but you can see how that can be used. So we're starting to build a system there which is highly respectful of what the agent has to achieve. With your terms, you're going to put terms in your offer. How you structure your offer is very important. The language you use, your proof of funding. We tend, quite often, we're not asked for proof of funding these days. So that's something you can look forward to when you've got a certain amount of credibility behind you and you back that with evidence. Words, by the way, aren't evidence. It's actually doing deals that are evidence, and how you've done them, and how you've overcome problems as well. You will have problems on developments, and the agents will watch how you overcome them, how you communicate. So always up the ante with your communication when you have those challenges. Tax, you need to consider tax. Commercial properties have a can be vatable. That's going to spoil your day if you put an offer in and you haven't realised that you've got 20% VAT to pay. So understanding that, working with a tax advisor and or accountant to understand your tax strategy. You can disapply VAT with a VAT 1614D form. It's an HMRC form, but you must get the vendor to opt out, so they will need to sign the disapply form with you. Again, another reason for being open with your commercial agent. If they're on board with it, they will be able to nurse the vendor through at least your reasoning. So again, very important. Always put signability in, please, please. You must. You wouldn't put that in the offer letter, but you want that in your exchange documentation. Okay, if something happens and you've got an exchange and for some reason you can't complete on it, or for your own internal administration, you might want to buy it in a separate legal entity. Shareholders might change, for instance. You might want to get rid of it and put it in auction with a planning gain. You must get assignability in that exchange of contracts, please. And slightly linked to that, decide who or what makes an offer. Most of our offers, we let them know that there'll be a brand new SPV set up. Probably won't have been set up, won't have a bank account at that stage, but we're telling them that that's what it will be bought in, and that's absolutely fine for most. Okay, deal analyzers can be great tools, can be like walking in a minefield. It depends what you use. Here are some of the common errors that we see. Quite often they're just simply too basic. They don't give a full picture. They only take each element in isolation, so there's no sensitivity analysis where you get the compounding of, GDV lowering and bill phase increasing in cost or duration, so funding goes up. Can you see how different permutations and criteria can move at will? So having a compounded sensitivity analysis is really important. Simply, quite often they're wrong. They miss out a lot of the costs. It could be some of the survey costs, some of the method of keeping you in a level of liquidity throughout the development, so any fees that you might need to be very open with your stakeholders. Some of them just incorrect, they're unaudited, got calc errors, but please do make sure they are as accurate as you can. And get a good one and understand how it's worked through, or start building it yourself. These are assets. We can't run our business unless we've got a pool of assets And that's not just property, but it's systems and tools and analysis. And remember this phrase, the truth emerges after the costs have been expended. And that's what you want to do. You want to make sure your due diligence is right at the front end of the process as far as you can. A commercial property, a RICS, Red Book valuation on a property will cost you somewhere between £2,000 and £4,500 plus that, even more on some of the larger developments. So at the point where you've got a draft term sheet, you pick your funder, the funder can't move forward unless the valuation's moving ahead, you're under pressure, and you need to pay them. They won't give you the report until you've paid the money. If they come back and say, well, you've made some fundamental flaws here, wrong calculations, GDVs are wrong, freehold, leasehold structurings inappropriate. If you haven't got that right, then you're going to have some significant problems. So you better get it right at the front end, otherwise you are going to be shelling out quite a few £1,000s of abortive costs. So back to the phrase bank grade due diligence. So that's our development analyzer. That goes into an infinite amount of detail, but it's quick, it's achievable, it's quick to do. If we're looking at a development, we can generally do 90 to 95% of that within a few hours if we need to work quick. Okay, we'd rather not work that quick, we'd rather work with a bit more time, but sometimes you have to move quickly, like Nigel with his haircut, Within 2 or 3 hours we'd put in not one, but also a second counter offer, and to secure it, and the building never went on the open market. Nobody else knew about it, and that is how we strike most of our deals, because people know we're a sure bet. If they offer us a development, that if we like it, we'll do it. Excuse me. Let's just see if we've got any questions. Irina, good luck with your SAS setting up. Mark, yep, doing it in London. And Tobin, we give our development analyzer, we share that with our masterminders for all our masterclass. Sorry about that. With all our masterclass attendees, they get all the cash flow analysis and development tracker tools. So hopefully that's answered your question. So these are some of the risks that can permeate through, and I'd like to dispel a few myths. On the face of it, opportunities are harder, vendors are driving expectations up, it's highly competitive, development margins coming down, risk profile up, less headroom in developments. Has anyone heard those sort of things being said? Yeah, I've heard them. And the reality is there's some truth in all of those. Okay, the market's moving all the time. So what we need to do is we need to be mindful, we need to anticipate all those challenges. We need full immersion in this as a strategy. This isn't a part-time strategy, but this can be life-changing at a level. But it will take a while to invest in the team. So the time to start is now, because in 6 months' time you'll have 6 months track record under your belt. You'll probably be into your first development, or at least closing in on the development, and you'll start to be bringing up your teams. Your rank and file of private investors will be there, really understanding your vision, your strategy. So yes, there are risks, be mindful, but don't be fearful of risk. Okay, risk mitigation is really powerful. That's why we spent a life in risk mitigation. You've got to have the good sense to invest in a team who understands what risk is and will help keep you safe, and understand what questions to ask, even if you don't know the questions to ask just yet. So there's always going to be change. Forever has there been, and forever will there be. And with that change, we need to be agile, tenacious, and we must have the knowledge and infinite capacity to be able to apply that with energy, with passion, and to absorb and capture lots of information from our professional team. And you can seriously do this. Everyone, I wouldn't be holding this webinar or explaining to people how you need to have a massive organization to do this. You don't. I know a lot of people are very successful, and there is just one of them. And this also is a strategy that you don't have to be the developer. You can actually come in as a part stakeholder in a development, whether you're brokering funding or bringing funding, or playing a part in this. If you've got the deal but haven't got the money, you can form part of this, and that can create a very elegant solution in you rising in terms of credibility and experience in the eyes of funder and other stakeholders, so that you can do these developments in the future. And this is the type of professional team. Our strategy would be underscored by the phrase, the strapline, well advised. Okay, you need good advice, but I'd just warn you one thing, please, and I'd like you to write this down. You can't outsource decision making. Okay, sometimes you'll get to a point where you've got lots of advice, but at the end of the day you've got to grow a pair and you've got to make a decision based on this advice. Sometimes that advice is competing. Have you ever had a solicitor, a tax advisor, an accountant all agree? Sometimes it happens. More often than not, there are variations on the theme. So these are, just built through these quite quickly, these are your professional team, your agents, your solicitors, your planning consultants, the valuer. Even though you may not be appointing the valuer, you may, but it may be the funder's valuer, and you're given a choice as to which one on the funder's valuation panel you use. Your broker, the funder, tax advisor, design team, QS contractor, the estate agents for any back-end sales if your strategy is buy, develop and refinance and hold, or indeed sell. So planning is something that has really enabled, since 2013 when permitted development came into play, it's really liberalised planning in many areas, not in all areas, but in many areas. So Class O has really opened up the B1A market for us as developers, and it's based on a societal need. There has to be a need in any market for supply to be met. So understand which market you're serving. We look at the young professional marketplace. We apply for Help to Buy scheme on each one of our developments. Desensitizes the price point slightly, but that comes with a social conscience and consideration as well. So the planning has really given us that opportunity, and with permitted development rights, which enables us to access, like this building on the right here, that's a 2-story reinforced concrete frame building. It's got some steelwork in it as well, but that's we secured that as 8 2-beds apartments, and each apartment was going to be between 86 and 96 square meters each. Palatial, I think you'll agree. So that was a permitted development. It was still a B1A office when we got our hands on it. This is the one that Nigel saw when he went to go and have his ears lowered at the barber's. We put permitted development intensification into it, so we changed it from 8 2-bed to 16 1-bed. It generally takes 56 days from submission to determination of a PD application. That one took us 45 days, so Colchester were particularly helpful there. We're very thankful for that. But permitted development has now changed again since 1st of October, where light industrial Class PA has come into the realms. So we're watching with great interest on buildings in Class PA, light industrial up to 500 square meters as a general rule, and there's some increased activity there, so interesting times. Always try and protect through your offer. You may say, and you may be right, in some cases, that why would a vendor want to accept conditionality? It is very, very common. Okay, you're only competing with what you're capable of. You're not trying to appease people. You're trying to allow people to understand, walk a mile in your shoes and understand what position you're taking on this. So I'd really encourage you to be very open with your offer and make sure you build that protection in. And for that, you may want to have a planning consultant. We have a planning consultant run a rule through each one of our developments at a very, very early stage. Sometimes just for a couple of hours, even before pre-offer, just to understand the history of the building, where it is, are there any opt-outs, checking that you're probably familiar with Article 4 with HMOs. Well, Article 4 is the instrument that local authorities use as an opt-out for permitted development. So areas like Bracknell recently put an Article 4 in place primarily for that purpose. So your planning consultant will really help you. But also look at the path least trodden as well. We're looking at a bank at the moment, which we can take additional height to the building, put an additional floor or two in there. Okay, that'll be full planning, but we can structure that and have indeed structured that, and that is working really well with the vendor of that particular property. So sometimes you can look at other properties which may be listed, may have long-term commercial leases on. Okay, we're looking at that with our SAS. If we can acquire commercial property that's still got 2 years left on some of their commercial leases, then generally we're going to be fishing in a lot thinner environment. There's going to be less people interested in that type of property. Most developers want vacant possession, prepared to steam straight into it. We're prepared to just keep our powder dry, hold the commercial property over a period of time. So this is Kelvedon House. This is a D1 education facility. And we've gone into the backlands of the property. It's about half an acre there, and we're about to get full planning permission for conversion of the D1 to C3, so it'll be half a dozen apartments and then 3 houses in the back, which will be 3 and 4 bed properties. So there's also the opportunity there where you could stitch together other pieces of land, and we've been successful in getting an option on an additional piece of land. So lots of things you can do there. Just make sure though that you don't create a behemoth there and something that just never gets to fruition. Sometimes you just got to focus on plan A, the first phase, and accept that phase 2, phase 3, that's great, you can work on those, but otherwise you'll end up having the greatest development. They'll never see the light of day. And this is about 2.6, probably actually increasing to about 2.7 million. And again, great returns there. The returns are pretty understated, to be honest. They include absolutely every cost. And our mantra is under promise, over deliver, because we have all of our stakeholders, of which we are one of them, best interests at heart. Okay, so we want the hockey stick approach, a nice upside towards the end of the project as we release any contingency that's been unspent at the end, and any upside on GDV and freehold leasehold sales, rather than having an inverted hockey stick approach and seeing profit peter away at the end. I've seen that in the construction industry for many years, and that's not a path we're prepared to go down. So timing, you found your great opportunity. It's fantastic, but it's too early for your commercial funders to come on board. They'll come on board at legal completion, and that's when their first funds will flow. Your private investor, again, really interested, wants to be involved, but it's probably too early. They'll probably bring their money in generally approaching exchange of contracts. So what I'm saying here is you're going to need some seed capital. And that might be anywhere from a couple of £1,000 for surveys on a permitted development, straightforward development, right the way through to could be quite a few tens of thousands of pounds if you're you may not be taking planning risk, but you may be taking the abortive cost of if planning fails. Your professional team still need paying if they're not on a fully contingent basis. So that abortive cost, that seed capital, is required, and you need to calculate that. We call it pre-EOC costs, pre-exchange of contract costs. Because once you've exchanged a contract, your bits are on the block. You are going to be acquiring that property, subject to any conditionality that you've put in there. So we always plan for these elements: your planning, your deposit, your professional fees, possibly your time. That will depend on your stakeholders' appetite, because obviously somebody would need to fund that. And the options for that seed capital is possibly your own funds. But do remember, and again, if you could write these words down, please: you are not your company. You as an individual are a different legal entity to you as a director of the SPV. So the SPV is one legal entity, you personally are another. So if you're using your own private capital into a development, you've got to separate the logic. You, by default, would then become a private investor, and you need to treat yourself as a private investor as well. You may look at retained profits, could be your SAS, could be other private investors' money. But the point is, it comes with a duty of care. It's not no money down, okay? It's somebody's money that is being used. Okay, if that project goes to hell in a handcart and you lose £10,000 of a private investor's money, and that's on a fixed interest loan note that needs to be paid back in 12 months, you borrowed 10,000, you've got none of it left, you've got 11 months and ticking to pay that back, plus the interest, plus a potentially fractured relationship. So be very careful on that duty of care, please. And it is possible, okay? There's no fear here. You've just got to be sensible, accountable with that duty of care. And quickly, with those loan agreements, all those elements there need to come to bear in a document, which needs to be enshrined by a solicitor. Don't be cheap. Cost a few £100, get a solicitor to do one properly. You'll thank me later. There are quite a lot of standard templates around. You can try and use them yourself, but I would always, the first one you do, always get a solicitor to look at it. Okay. Excuse me. Trust is at the heart of any relationship. Okay. Keep that communication going. I see so many loan notes being signed, and then people just disappear off the planet for a year, 18 months. Some people will get instinctively very nervous if you're not communicating with them on a regular basis. And I don't know whether many of you have seen our latest newsletter called Insight. You've probably seen that circulating around. If you go to www.EquaLife, EquaLife.co.uk, EquaLife.co.uk, to the first page and just scroll down, you'll see a PDF of our latest newsletter called Insight. And we do that to communicate with our private investors pretty much entirely, to let them know what we're doing, how the business is going, what our culture, our values are, how we're working with our younger generation, and they get to know us and understand us. And it's a way of us broadcasting our position, our progress, our opportunities to them on a one-to-many approach, which is wonderful. Sometimes with loan agreements, depending on how you structure them, your solicitor may decide that they need to be declared to your senior debt provider. Your senior debt provider, your primary funder, will always want to understand that any debt is subordinated below theirs, i.e. they have first charge, they get paid back first in any default situation. So again, just things to be aware of, just think of the logic of that, but there's ways of structuring that. And I'm not going to go into this in any detail. I think many of you will be very familiar with loan agreements, but the amount, the exit terms, how your returns are paid, the interest amounts, but also are they rolled up monthly, annually, and what level of security. And I'm just going to give you 2 tips here just to close on this particular section. Try and link your duration of a private investor loan with an outcome, not a duration of time. So if you're bringing money in for 12 months, it will be paid, but needs to be paid back in 12 months. If it's going to be within 12 to 18 months upon refinancing of something, then can you see how it's subject to something else happening? What you don't want to be doing is refinancing something midway through or halfway through. That's quite a difficult refi and put a lot of pressure on you. So that's the first tip. Second tip is always have a penalty clause in there. Okay, you want to be penalised if you default, and that sounds counterintuitive, but if you're in default, or rather if you don't pay back, you'll be in default of contract and you'll be sued. If you don't pay back on time, God forbid, then there needs to be a penalty clause in there which says that, I don't know, the interest goes up from 10% to 15% or X% above a base rate. Okay, so you want that penalty clause in there. It will protect you as well as penalise you, but it's the protection that I'm focusing on there. So the valuation, the GDV, okay, probably the most volatile part, along with potential contractor's price that you'll come across. This is a bit of a landscape of how we approach our GDV. Just going to check any questions here. Another CGI, I see. Thanks, Jacoda. Yeah, you can set up SIPs. The advantage, this is CAS, the advantage of a SAS for us was it allowed us to do loan backs. Okay, generally you can't, well, almost certainly you can't invest in residential property with a SIP or a SAS. But with a loan back, we can loan money from our SAS on a securitized basis into an SPV or into a company, and then that company can generally invest in whatever it wishes. So a SAS gives us an awful lot of flexibility. Lee asks, looking at the GDV and the profit percentage, what would be the ideal and minimum amount of profit you would accept? I'm going to answer that in two ways. It's a really good question, Lee. So pens at ready. Minimum percentage, first of all, to who? Bank grade due diligence. The bank has an interest on how profitable your development is. As a general rule, your funders want to see a minimum of 15% profit after funding costs. That's generally a minimum. You'll hear lots of numbers bandied around. Don't go below 15, go 16 to 18, nothing under 20, 25%. Well, it's all subject to what? Okay, is that 25% before funding costs? Is it 15% net after every cost? We only use our numbers after every cost has been accounted for, and generally we're 16, 17, 18%. So if there really is a very, very low risk profile, we may take a view on that. But get your terminology right. Always start to look at the history and look at trends of each one of your calculations, and store statistics from some of your older developments which are complete, so you can continually see those trends. So I would either go gross profits including all costs except funding, and also look at net costs, net profit, I beg your pardon, after all costs including funding. So just the difference of funding, because you may want to show your commercial broker your profitability before funding costs at the offset of the project, rather than declaring what you think it would be. So they're the two costs there. So hopefully, Lee, that was useful, but we can come back to that. We'll have time for Q&A at the end. So the GDV, if you can see my cursor there, it can depend where your unit is. If it's on the ground floor, it might well have a lower GDV than if it's on the first floor, as an example. It will depend. There's a mix. This is just an example. There's a mixture of 2-bed, 1-bed studios here. We'll always do unit sizes in old money and new money, feet and meters. The industry is fairly inconsistent, although I probably see feet used more often than meters. We'll then do GDV on a low range and on a high range. Now we do this for our own purposes. I think if I said a development is going to be 2.648 million, the reality is it never will be. It'll be a little bit more than that or a little bit less than that. So rather than have a number, let's have a realistic range. Now we don't give that to the banks. The banks are educated enough to make their own decision with their valuers, but we do give it to our private investors. And this comes back to that duty of care and how you work with people and create relationships and nurture those and look after their interests over a period of time. You want a private investor to understand risk, because their risk appetite is really important. You want to understand that they're a sophisticated investor under FCA 13.3. Get them to give you proof of ID, proof of funds, a sophisticated questionnaire, investor questionnaire, all these things. And they don't just happen. You don't just drop them into Dropbox and ask them to sign that. So this is a way of showing them a spread. And they'll probably ask, why is there a low range and a high range? And that gives you the opportunity to explain what the variables will be. Okay, maybe you've got some contingency here that might vary. Maybe your GDVs have got a spread. So typically our low and high range here, you see here, the low range is generally the valuation, the RICS Red Book valuation. They're the guys that got sued in 2010 onwards when the banking crisis happened. Okay, the bank took it on, the only party with any professional indemnity, and sued them. So they're always going to be pretty dour individuals. Okay, so that's going to tend to be at the bottom end, the low range. At the high range, that tends to be more the agents who are competing for your business. They're sure they can sell, they can get great attractive GDVs there from you. So we tend to find they tend to nudge up. And the reality is they're not going to be at that level either. They're probably going to be somewhere in between for our purposes at due diligence level. So you can see from those elements, these are the apartments. The gross development value in this particular case is going to be between 5.469 million and 6.018 million. We're then putting in car parking spaces, garden areas, storage units, any ancillaries. And then we do this depending on the geographical area, but then this will be the title splitting. We're selling 125-year leaseholds for each of the apartments. Generally, they're 1 or 2 bed apartments. And then there's the freehold sale will be based on the ground rent. In this case, £275. There are 40 units, and at a 30 times multiple, which is about 3.4% yield. And if you think about it, a ground rent, £275 a year, is anybody not going to pay that? The penalty for not paying that to its ultimate conclusion would be you'd probably lose your apartment. So for 275 quid a year, that's seen as a pretty bomb-proof residual form of income, and that's why pensions and they're long-term hold, low yield but absolute bulletproof. So you can see how we calculate that. So in this calculation here, 40 apartments, 275 at 30 times income, multiple of income, so times those three together. And we've got a lower range here where we can alter this to be 25 times possibly, or something different, 35 maybe. So there we go, that's how we do valuations. So your commercial broker will understand all this. We use one in London who understands big deals, understands the market. You will, unless you've got an eye for detail and just want to spend all your time tracking the market, you'll never know what deals, what opportunities and the movement in the market. So get yourself a very good broker. They're absolute specialists. Most of them will look at pretty much the whole of market, and they also understand the risks that will go through, and they'll also pre-arm you with the information that you'll need. Not in every case, and it's one of our one of our continual gripes to the funding community is they're not transparent on what documentation they need and when. They're not very good at laying out their roadmap at all. So would it be helpful if you understand what that roadmap looks like, so you can prompt your funder to tell you when you need to take your advice for your personal guarantees and things like that? Because I guarantee you, people don't tend to remind you of those until they're heading towards the end of the development or the due diligence for exchange. So your capital, you'll be using commercial and development finance almost certainly, and that will be a mixture of senior debt, stretch senior debt, and mezzanine. More often than not, it'll be senior debt, and then you'll be using private investment. And that could be via your own funds if you're a private investor. It could be family money, however you've accessed that money through private investment, through sophisticated investors, could be through angels, family offices, quite a number of individual parties, but structuring of that is really important. This is Oak House. We've covered this a couple of times, but about 8,500 square feet, B1A to C3 under PD. So it went from 8 2-bed apartments to 16 1-bed apartments. Just over 2.6 to 2.7 million GDV. Excuse me. And again, a very healthy profit. Really nice development project that is, very low risk, beautiful site, lovely area, 100 yards from Castle Park in Colchester. So when Nigel found that one, you know, that was right in the heart of the Dutch area of Colchester, and we've got a number of others that we've got in Colchester as well, one of which was about 28 apartments. So you've got to decide what it'll mean for you. Is it a vehicle or is it a goal? You know, the time and money will give choices in life. I mean, that's just reality. And with the time, this strategy will give leverage from the experts. You'll have proven systems that you can access, and you'll have a greater assurance because you'll be accessing credible parties. No bank wants to hear that a future of the development they're lending on is down to Mark Stokes trying really hard, because that really doesn't give anybody a huge amount of confidence. What they want to understand is Mark Stokes has appointed a design party with £3 million professional indemnity, has employed a professional main contractor with a great bank grade covenant which is acceptable, with liquidated and ascertained damages, with this PI, and can you see the different structuring there? And then the money, that commercial leverage, there is a lot of money available. It's a very liquid market at the moment, so commercial funding is eminently available. And you've also got the opportunity to negotiate. You can negotiate hard with commercial lenders. You may get somewhere, you may not, but it's not the computer says yes, the computer says no, okay? You can have a very sensible conversation. You're creating solutions for sophisticated investors. There's a lot of money out there. I mentioned the 24 million odd that I've been having conversations with over the last couple of days with various people. Okay, they want greater returns. Okay, so don't be timid. Talk to them about your values, what you can offer, their risk appetite. You know, ensure you understand their track record. What does great look like to them is a superb question. And if you've never asked somebody that, first thing tomorrow morning, ask somebody, irrespective of context, what great looks like to them. Okay, you're acting in their interests as well as yours. And the type of money that can be achievable, okay, let's say I don't do 3 steps to £1 million in a fortnight. You know, these take a while to develop, but you can gain, you know, profitability on these developments of several hundred thousand up to several million in profit. You know, you'll be sharing some of that, potentially up to 50% of that with other stakeholders. So you need to be realistic. It's going to take time, and you've got to defend the village and pay your bills in the meantime. So working out how you make a liquid position for yourself while you're doing these developments. And I cover that a lot. I mean, we spend, you know, the best part of a couple of days looking at those type of options, because that's really important as well. So where you find investment, I mean, It really is everywhere, and that's a really frustrating thing to hear when you can't find any. But it's building, nurturing those relationships and going step by step, being authentic, being passionate, making sure it resonates in what you do. Network with substance. Don't try and be famous for networking's sake. You know, people want to see evidence of what you're doing to invest. So be known for what you do and what you facilitate in others, and evidence what you've done. Okay, what you're doing, what you've done, not what you've got. Okay, you can find funding in many locations. I hear flying, golf, sports clubs, Formula One, all of those areas. The only thing I would say there is find something you love. Okay, because if you hate golf and you're trying to find funding in a golf club, it's going to be a pretty boring existence for you. You want your passion to radiate, and these are my top 5 personal thoughts on this subject. You know, do what you love and it'll radiate. Okay, you really want to absorb it, particularly in commercial conversions. Just press yourself, expand yourself consistently. There is so much to learn in this area, and you'll learn that by interacting with people. So if you're a good people person, this is a fantastic strategy for you. Enjoy the people's company that you're with. You know, we have a life of choices, and one of those choices is to work harmoniously with people you enjoy being with. Okay, that's a choice. We turned down £400,000 of private investment 12 months ago because actually we didn't feel we were compatible with that person. That takes a pretty robust values system to do that, and that wasn't easy. But when we looked at the pros and cons of jumping into bed with somebody, you know, in an organisation, it was a very easy decision to make. It had consequences, but you know, we weren't prepared to compromise short term for the long term. Be proud, but stay humble, and create shared value. Create shared value for every stakeholder. And what you're going to need to do that is you're going to need your reputation. Okay, you've only got one reputation, and I have to say, in this marketplace, having had 3 decades of experience in business around the world, you don't have to be too professional to stand out sometimes. And I encourage you to just reflect back on what you've seen on Facebook. Okay, there's people dropping the F-bomb left, right and centre. Apparently it's really clever to be swearing all over the place. Like, everything you do leaves an indelible footprint. Okay, you can't fake who you are, and please don't get caught up in somebody else's opinion of themselves, their hype, their emotion. Okay, your directorships, social media and credit rating are probably the 3 areas that are just so easy and transparent to authenticate and to verify, and banks are now checking all 3 of those. Okay, so the last part on this particular slide, I want you to write this quote down, please. It's something that I've imparted some wisdom over the years to many people. So your largest investor you never had is the one you never knew was watching. The largest investor you never had is the one you never knew was watching. How many times has somebody came up to you and said, oh, I've been watching you for a while and wonder if we could have a coffee? I had somebody do that 18 months ago. They're now interested in lending 2 million. Now, if they didn't like my attitude, my approach, and we're all different, we all appeal to different people, there are no rights and wrongs here, they would have never engaged with me, and I would have never known they were watching. So you're not just trying to impress the people who you're with just by your courage of your convictions and being honest and the person you are. I'm not trying to change who you are, but I'm just trying to say there is a consequence of your action if you try and get hyped up in some emotive capacity in some of the communities that I see, where people are encouraged to almost be something they're not because of a peer group or the grass is greener on the other side. So just take note of that and just temper that to be and recalibrate to who you are. And that will enable you to walk a mile in other people's shoes a lot better. And when you're negotiating, that art of negotiation, I've been involved in negotiations of, you know, hundreds of millions of pounds and renegotiating bank long stops, recovery positions, repossessions, you know, very, very acrimonious positions. And negotiating, a lot of negotiating is about listening, okay? It's not about what they say, but it's about finding out what they want. You want that win-win. So your partner can bring any number of things, and will probably need to bring more than one of these things for a deal to happen. So that could be a deal, the money, brokering money, experience. I've been a non-executive director for 9 years now, since 2008, I think it was, of many different companies. So that's a great way of getting you know, partner experience to the table. There could be mentorships, there could be specific skills that you're missing, but generally deals, money, time and brokering of money probably are the main elements. But let's not underestimate that last one. You know, the confidence of having somebody by your side who knows what they're doing, who will allow you to come along into their slipstream and work with them, look over their shoulder. That is very powerful. And that's what some of our mentors do, or mentees do. They may have the money, but actually don't have the experience or capacity or time, or let's face it, the want to do this. So they like to look over our shoulders and learn as we go, which is a great opportunity. And you may choose to take a similar approach or something different. So we mentioned SPVs, and I promise you I'll take you through this. Now we know there's considerable responsibilities and obligations of anybody taking on board a position, a directorship or shareholding in a company. Fiduciary responsibilities, personal guarantees from the bank. Now, shouldn't be afraid of those, just be aware of them. They are a necessity, and as long as you know they're there, a bank doesn't want to throw your kids out on the street and sell your house from underneath you. If anything goes to hell in a handcart, I mean, of course, they reserve that position, but generally a personal guarantee is something that holds your feet to the fire. Okay, the worst thing for a bank is to have a position where they have a partially complete project and a walkaway situation. They don't want it, and they certainly don't want a director or a team of directors just tossing the keys to the development across the table and walking away. So they want a personal guarantee. First and foremost is holding the directors' feet to the fire and keeping them accountable and focused on getting through whatever hardships there may be. So who would like to see an SPV structure? So before I do that, just check we've got a few questions. It's a pleasure, Lee. Okay, quick question from Irma. Irma, how do you evaluate the comps and the valuations, the sell rate and the lower and high? Well, first of all, we look at the comparisons. We only go within a quarter of a mile of our location. We want the aspect, the location of the property, the height of the property, ground floor, first floor, second floor. We'll go to the EPC register, we'll look at the square footage, square meterage of what was sold. So we're always looking not what's on the market, but what's sold. And then we'll reduce it all down to a comparable cost per square foot or per square meter. Okay, and that's how we'll build our comparables then back up into the appropriate sizes of each one of our apartments per square foot. So hopefully that's of use, but we spend quite a lot of time on that. But we know our areas as well, so there's some workshops and exercises that we do in the masterclass which will help you there. Are your profit figures gross to EquaLife or net of fixed and variable costs? Figures we tend to use are net of all costs. Okay, the only time we generally use gross costs excluding something would be when we go to the funders and say, this is our development. We won't tell them what we think the funding costs are. we'll just leave it net of funding costs and allow them to give us the draft term sheet, and then we'll apply that and cash flow it. Okay, I'll come back to some questions later. So SPV structure, hopefully you'll find this of interest. Sometimes a picture speaks 1,000 words. So this is your SPV, a limited company, let's assume, although it could be an SPV, it could be a offshore, it could be a trust, an LLP, but let's assume it's a limited company. So you're bringing your commercial finance, which will be senior debt and maybe mezzanine. There'll be institutional investors or institutional investments, so the banks. Then you'll have private capital, which will be brought to bear through either shareholding and or a loan agreement. And then there'll be, in our case, there is what we're bringing to the table. So our share, if it's 50-50 shareholder split, 50% would be with a private capital party, and the other 50% would be by our holding company. And we find all of our SPVs and operating companies sit under our holding company structure. It's a lot more tax efficient for us. Then the SPV would appoint a design and professional team to conduct the overseeing of any consultancy work. That may be more than one appointment, although we'll try and appoint a lead designer, and that will also be compliant and complicit with CDM regulations as well. And if you don't understand health and safety, you need to. Okay, you need to understand that as a client, as the developer, you have some serious obligations which aren't difficult to abide by and comply with, which makes it even more important that you know what they are and how to comply with them. So it's very straightforward, but you need to know them. The SPV will also appoint a main contractor, and that will be under a model form of contract, generally, probably a JCT or NEC form of contract, could be IFC, could be a number of standard forms that we've used over the years, but the important thing here is it needs to be a suited contract, which enables the main contractor ideally to use that with his subcontractors, suppliers. And that's important because it's also important for the commercial funders to understand the form of structure and contract. Your bank will almost certainly want to see the form of contract and will also want to understand the main contractor and the covenant strength of the main contractor you're going to use. So you're entering into a different world here where you're not going to be getting your favourite window installer in and your plasterer and your bricklayer and nickel and diming it. Okay, you want the assurance package to remain whole. So don't think that you can go and buy timber, 10p cheaper down the builder's yard a linear metre. Actually, you want the assurance package maintained as a whole because it's important to you, it's important to the bank, and they want accountability and look through to make sure they're not reliant on you being able to get down to the builder's merchants and buy the timber and deliver it to the site at the time when the carpenter needs it. Okay, that's not your job. It's the main contractor's assurance and accountability. And then, of course, you've got your buying party, your sell contracts to your individual leasehold purchasers and your freehold, and that's assuming it's not a refinance and hold. You'll have wraparound collateral warranties, almost certainly, from your commercial funders to your design team and to your main contractor. And what we're saying here is if the SPV falls over, if the development goes pear-shaped for whatever reason, the bank beforehand want to understand and want a contract in place to look through so they can go around the failed limited company. They've still got cash in hand because they're only paying monthly in arrears for works done. So they've still got enough funds in their bank to finish off paying the main contractor to do the work. So why would the main contractor not want that? I don't know. The main contractor, if the SPV becomes insolvent, the main contractor wants to be paid and wants to finish off the work. So they're happy, and this is all done before exchange and completion, or before completion. of the development and the onset of the main contract, so everybody's aware. And then you may well also get some novation depending on whether it's a design and build, and I'll take you through lots of detail of procurement strategies and the like if you're interested in working with us. So a bit of time on cash flow. Anybody who's been in business, if you're not talking cash flow, you're on a completely different planet to me. Okay, this is the business acumen. When you have a term sheet that comes through from your funders, quite often the term sheet will say, this is the loan to cost, this is your threshold loan to value, therefore this is the amount we will lend you. And then interestingly, what they also say is, and therefore you will need to provide X amount of equity. I guarantee you that number is 100% always wrong. And the reason why it's wrong is it doesn't account for cash flowing the development. Okay, simple cash flow analysis, and we give you the tool. You must cash flow it. As an example, you'll quite often find the main contractor will be applying 5% VAT, but quite often your commercial funder will not fund VAT. Okay, so if your monthly applications from your main contractor are £100,000 a month plus 5% VAT, okay, that's £5,000 each month that the bank won't draw down for you. So that soon mounts up, £5,000 a month until you can get your VAT returning, because your SPV is going to be VAT registered. So those 10, 15,000 odd pounds, and it gets worse with your professional fees, because they're going to be at 20%, not 5%. So just be aware you have to cash flow, otherwise you don't want to be, you may have to refinance halfway through your SPV, and then you're potentially going to be giving away valuable equity, or you're going to be in a whole lot of strife. So cash flow, cash flow, cash flow, it's the oxygen in your lungs. And also apply that to your personal cash flow as well, because I'm assuming you want to pay the bills throughout the course of this, so we need to make sure there's some liquidity there and open sight with the funders and the private investors here, that everybody's happy that there will be some liquidity passed through to various parties who are going to be doing the legwork in the development. So hopefully this is starting to make sense. This is running it as a business. Okay, we can all get emotional about going to find a development, but if you're not cash flowing it right at the front from your due diligence stage, you're simply going to be asking your private investor for the wrong number. And I would suggest to you it's not a very good idea to cement a relationship by shaking with a private investor that, yep, £500,000, great, and then going back to them 3 weeks later and saying, actually, it's not 500, it's 575. That's not going to cement a good relationship for the future. So you better get it right first time. Right, very quickly, we call it transaction project management. 4 things you absolutely must do to get to the start line of a legally completed development ready to go into construction phase. Number 1, you've got to do the conveyancing. That's a whole process in its own right, and most of you will be aware of that. Number 2, you've got to create the legal entity, the shareholder agreement, the structure, the articles of association, the bank mandates, the delegated authorities, all these elements that come in as a suite of documents there. Reserve matters under shareholder agreements and the like. Got to onboard the commercial funding, and we've got to onboard the private investment. Okay. Obviously, after we're legally complete, then we've got the main contractor and the whole procurement phase, which will be substantially complete probably by that time anyway. That will come into bear as well. And there are lots of distractions out there. Most of you who know me know I love this phrase. Frank Williams from Williams Motorsport, does it make the car go faster? Whenever he's been given in business life an invoice or a purchase order, a requisition note to sign, he would always look at somebody square in the eyes. Does it make my car go faster? Because he knew his absolute focus and objective was to make sure that car went round that track quantifiably faster than any other car could. Okay, so you need to know what your vision is, what your focus is, and make sure you've not got distractions. There are lots of nice to haves out there, so you need to get your filters on. Some have a great return on investment, others are either ahead of their time or maybe don't at this stage, so do be aware, please. That's probably the single biggest mistake. I see a lot of new entrants to the market. They focus on the wrong things. Okay, the things they like doing, or the things that get quite a lot of appeal on Facebook, but the reality is it's the gritty stuff that gets you moving in this environment, spending time with the right type of people where you'll have your funding and your development pipeline emerging. So the development analyzer, okay, really important document. Do you know how long this lasts for us? Up to the point of exchange, probably just before, and we don't use it again. Okay, it then moves on to another intensive document, which is a development tracker, and that tracks all your retention payments, all your commitments to all your professional parties, to all your main contractors, all your liability schedules, all your variations, all your change control, and anybody who's got any quantity surveying background will understand that is a huge task to manage. It's not a difficult spreadsheet, but it's a huge system to manage and a most crucial element. Okay, that's where you're holding on to your profit and your contingency, while still being fair and ethical to your supply chain. So that's what you need. You need that development analyzer that will take it. Sorry, you need to go beyond the development analyzer and look at your development tracker and your cash flow management, which we talked about earlier on. So these, in cost management terms, these are your 4 simple processes and steps. You need to know your costs, you need to control your costs, you need to monitor your costs, and you need to take prompt action. Okay, don't wait for that gut feeling to then emerge into significant overruns. Okay, because the moment you've got overruns of time and cost, your contingencies will burn very low very quickly. Okay, I don't want to scare you, but we're talking about, this is adult language here. This is an organisation that we're heading, and if you've got the right systems in place, it really isn't that difficult. You can employ a QS, hold them accountable. It won't guarantee you absolute success, but then at least you'll be auditing the auditor, so to speak. And remember, at all times, your funder is watching you. Your funder will appoint somebody called a monitoring surveyor. Monitoring surveyor is somebody you can get a working relationship with very quickly, and you should. I'm not saying there'll be any favours done, but it makes the slickness of the timescales. Builder puts in an application. If you're on 14-day payment terms with your builder, but you're on 21-day drawdown from your bank, you've got a problem. You can have a 7-day cash flow shortfall. So you need to make sure you suite your contract with your builders very transparently with your bank, because neither party, you nor the bank nor the builder, want a short flow of any party, because it's not necessary. You just need to openly communicate and work out with clarity, and then hold yourself accountable to achieving those dates. So look, we're very proud of what we do. You know, young entrepreneurs, these are 4 of our team: William, Dan, Jess and Tom. They're our young entrepreneurs, and a bit like Patek Philippe, you never actually own a Patek Philippe, you merely look after it for the next generation. It's that legacy. Okay, we hear about legacy a lot, but what will your legacy be? How will you structure it? Who will you hand it to? And will they be equipped to handle it? So for us, it's not about legacy at all. It's about custodianship. Because that legacy we're creating, and these are going to be voluminous developments, and there's many of them, we have to indenture, nurture the qualities that will allow our younger generation to take the great work we've done, but then take it to an even greater level when we're no longer able to do that. So that's part of our giving back. That's what Commercial Conversions has allowed us to do, have the time and the energy and clarity of focus to be able to support our younger generation. That's me presenting a prize to at PPM Brooklands, actually, to my eldest daughter, Katie. This is hot off the press, an article I wrote for YPN magazine. So those of you who subscribe to YPN magazine, you'll see an article there from me in one of the pages. So hopefully you'll enjoy that. And if you haven't done already, if you'd like to subscribe to my podcast, Inspiring a Young Entrepreneur, you're on this webinar, you're the first to know that Joseph Vellante is my special guest, and that's going live tomorrow morning. I interviewed him earlier on this week. He was the winner of the Apprentice in 2015 and doing incredible things with Improgas. So you're going to just love the podcast episode that launches tomorrow morning. So please feel free to go on to Inspiring a Young Entrepreneur, subscribe and leave us a review. That'd be very kind of you. So as you can see, that is our economic equation. We've been through most of those elements. I said it's going to be really packed and informative, and I know I've jammed an awful lot in tonight, so just keep bearing with me for a little bit longer. So our masterclass, if you want to know more, we've got 2 more dates until the end of the year. Next Tuesday and Wednesday, the 31st of October and the 1st of November. And then we've got the 5th and 6th of December. Okay, 2 days, come and join us. It's really nitty-gritty 2 days, okay? If you want to come to be motivated and do back rubbing and fist pumping and high fives, I'm probably not going to be for you. If you want to understand what it really takes, and I'll keep you safe as best as I can, but I'll also show you where the boundaries are as well. Okay, the systems, the processes that will really, really help you take those formative steps and really accelerate your business. So it's called an Advanced Commercial Developers Masterclass, because I believe the only content you can give is the reality of what it takes. There's no half measures. I haven't got a course after this, okay? So I'm not going to drip feed you information and then whine you into the next development. I've already said I only do a mastermind after that, which is fantastic, but it's a day a month, and that's about you and your business plan. This is the only teaching 2 days I do. Okay, we'll go through our case studies, lunch and refreshments all on us. We'll pay our own way for a networking dinner in the evening, on the middle evening, but you've got me from 8 in the morning till 6 at night, and then also through till 10, 11, 12 o'clock, as we'll keep the bar open, and I'll answer your questions there. So for you guys tonight, the first 3, you get a 30-minute call with myself. I think you know me. I'm not particular. Maybe I should be more precious with my time, but generally anybody who reaches out, I'll give them a helping hand where I can. But I'm having to start to restrict my time now. So if you want a 30-minute call and you book up now for this masterclass, I'll have a 30-minute specific call, help you with your strategy. And also I'll invite you to be my complimentary guest and come around and have a look. Spend the morning, we'll have a good few hours and have a coffee, and I'll show you around the development, one of our developments. And I'll also throw in a repeat attendance. You think there's been a lot of information this evening? Well, your brain's going to be spinning at the end of 2 days with us. So I'm going to invite you back for a second time, anytime within the next 12 months, because there'll be nuggets you missed, okay? And also life matures and the course will mature as well. So that's the price. That's on our website now. But for you guys, I'm actually holding the price. We put our prices up at the end of September. So I'm going to hold that price. It is only for tonight, okay? Not for tomorrow. I've got to be fair to everybody here. So for today, if you go onto that website there, equalife.co.uk/ACDM, and put in the code CCF17, CCF17, and it's 897 plus VAT. Okay, that's a 2-day course, and you spend some time with me as well on a call, a site visit, and you can come back and do the course again, all for the price of a set of patio furniture. That's not bad in changing your life, is it? So I don't need to do these courses. I actually just really enjoy doing them. I've mentored people for 20 years, and this isn't where I make my money. I make my money on the large developments, and that really gives a That's where I get my mojo, and I want to give you that back. So, what does it really take to succeed in commercial developments? Well, I think we can determine that it's your determination on how you want to achieve your life goals, understanding what they are and taking them to the next level. Your passion to make a start. You've got to make a start. Don't procrastinate. Okay, you've got to make a start. Fail forward, you'll make some errors, but you'll do those in the presence of people who know what they're doing. Okay, and that is a safer place to be. And then acquire and apply that knowledge. Okay, so what's stopping you? It is absolutely possible. I've got faith that everyone can do it. It's going to be harder for some than others, but with the right support and indentured network, it's absolutely achievable. So look, I appreciate I've gone a little bit over time. Most of you had stayed with me. In fact, all of you have stayed with me. Thank you. So I'm here for as long as you want. Let's get some questions. So please fire away any questions. Let's have a look here. Okay, somebody's asked on the course dates. Again, let me just go back a couple of slides. So they're the course dates. Okay, next Tuesday and Wednesday. It's at Mercedes-Benz World. Most of you know that I love the high performance culture of automotive and aeronautical engineering excellence. It's a real high performance business acumen. Somebody once said about Formula One that it's a sport for 2 hours on a Sunday afternoon, and for the rest of the year it's a business. Absolutely right. So Mercedes-Benz World, if you haven't been before, come along, meet me. Let's have a coffee at PPM Brooklands. Next date is the 9th of November, but you'll also have the privilege of being at Mercedes-Benz World with me next Tuesday and Wednesday, and/or on the 5th and 6th of December. And the reason why I say and/or is you can attend the second time complimentary. So you could do both of them for £897. So hopefully that clarifies that point. Another question here. Andrew, great call, Mark. Thank you for your openness and transparency. That's very kind of you, Andrew. Look, I have to be open. I've mentioned duty of care and accountability time and time again. Okay, I'm not going to do the 3 steps to £1 million in a fortnight, because actually life's not that simple. It's damn hard work doing what we do, and pretty much everybody on here will be either entrepreneurs or want to be entrepreneurs. If I don't tell you how it is, then actually I'm luring you into a false sense of security. Okay, you want income, you want to replace your income. It takes longer, I think you'd all agree, than what you think it will. Okay, you can't just go and get 2 or 3 HMOs and in a fortnight, in 2 months, 3 months, you've replaced your income. Occasionally that might happen to a few, but generally it takes an awful lot longer. This is a meaningful strategy that can absolutely bring huge volumes of experience and income to bear over a period of time, and you'll look back in a year, 18 months time and see a very, very significant change to your growth outlook, not something that has just given you a few extra £1,000 in the bank each month. Okay, and you will have to look at your strategy, and I'll help you look at your own personal strategy here. We talk quite openly about what it takes to pay the bills, keep the family happy, and keep them in the manner they're accustomed to, while these developments take time to mature and nurture them through. So that's a real part of being an adult, being a dad, being a husband, or in many cases, we've got a lot of ladies on the call tonight. Being a mum and being a wife. Okay, you've got other parties to protect. I've been married for 19 years. 4 children. Emily's 7, Katie's 10, Jack's 14, and Ben's 17. In fact, I think they're all going on 17 some days. It's you know what it's like when you've got an active household. But we've all got responsibilities, okay? So I don't do the emotional stuff. When times get tough and a private investor wants to invest with somebody, they know there's going to be tough times ahead, okay? Life's never smooth. So who do you want in the trenches with a tin hat on beside you when the shots start getting fired? Well, you want somebody who's emotionally calm, not somebody who has an emotional rant and starts freaking out at every twist and turn. Okay, you want somebody who's calm under pressure, calm under fire, somebody who speaks infrequently and listens frequently, takes time to digest information, takes time to understand the point of view from other people, negotiate what they need, what they want, what great looks like to them. So it's that calmness under pressure without all the animation and drama that, quite frankly, is kind of Hollywood, really. So thank you. That was very much appreciated, Andrew. Yeah, Caroline. Yeah, I have done masterminding and mentoring for SA in the past. That's not something I'm doing in the future. So if you want access to me, then you know, this is the only route through this masterclass. To be honest, my time is I will only ever do a proper full job, and now I've got just too many interests. I can't give the right time to everybody who's calling on my time. So yeah, I won't be doing that in the future, but thank you for really appreciate that. Thank you, Mark. Thank you for the feedback. Yeah, always here, so give me a shout. So Irina, SAS, strictly for commercial investment. Most commercial development is to C3. What is the mechanism to get refinancing? And what's the appropriate point of the project? Okay, so I think what Irina's saying, this is really important for anybody who's considering a SAS. You can't invest as a rule in residential property in a SAS. You can do a loan back to another company of yours, and then as long as that is securitized in some way, as a trustee you have an obligation here, and a lot will depend on the attitude of approach and policy of your trust administrator who you might employ. Okay, so we've done quite a bit of work on that with everybody at Brooklands over the last couple of months, because that's something that's of interest to many of us. I think what Irina's asking here is, when you're doing a commercial conversion or development project in a SAS, there'll come a point where you've taken the office and you've turned it into apartments, and you can't turn it into apartments because you can't own residential. So there's a point where there is the certificate of occupation, which is generally when your services have all been plumbed in, and that's when you get the certificate of habitation of the apartments. That's when they cease to become office or a construction site and become a habitable C3 property. But they're still, so you would have to refinance before that point. So you're refinancing, or you're actually selling from your SPV, from your SAS into an SPV on a development which isn't quite finished, which is not quite ideal, I think you'd agree. So the strategy we take, and this, I could have made this a little bit of a shorter statement, the strategy we do is we don't develop in our SAS. Okay, we might get the required planning in the SAS. Whilst the SAS can't trade property, we prefer to have the property transferred into an SPV, even though there might be stamp duty, land tax implications. get it out, get it into an SPV, and then develop it, and then you're not worrying that in 9 months' time you're going to have to refinance a partially complete project. Hopefully that makes sense, but again, we do tend to cover that off in some detail as well. Mark, your honesty and openness comes across a lot. Thank you, Mark. Yeah, look, we have to be open and honest. You know, I don't want to give you any impression that this is a backslapping high five strategy. You don't have to have come far in buy-to-lets, HMOs, service accommodation, or any of these strategies to know that that stuff sells courses. And whilst I have a course to sell, look, if this isn't right for you, don't come on the course. You know, if you want motivation, don't come on the course. If you're motivated and inspired by knowledge and how to actually do it from people that have been doing it for years and years and been in business for years and years, reach out and I can help you. So Jagoda, what's your ratio of conversions kept, rented out to conversions sold? Okay, so two parts of the strategy here: buy, develop, and sell, title split and sell, or buy, develop, and refinance and hold. Our strategy at the moment, and probably for the next 10 to 14 months, is to buy, develop, and sell everything. We are starting to look at how our strategy at the back end of 2018 will start to season and mature into a blend of both. Now, we'll never, on a single development, we'll never sell some and hold the rest. We will either sell in its entirety a development, or we'll hold in an unsplit, in a non-title split manner. So we'll either do one or the other, we'll never do a mix. But we want a blended strategy where we'll hold some developments and we will sell the others. But at the moment, it is purely a buy, develop, sell. We know what we're good at. We're absolutely focused, you know, laser-like, crosshairs on the target. And when I set a target, the target's already achieved. I've just got to work out the mechanics and the roadmap to get it achieved. That's the mental conditioning, really. Irene, you like that, did you? Calm under pressure and under fire. And that's right, you know, we all need a tin hat to put on every now and again. We feel as though flak's raining down on us. And life can be hard, and as long as we're equipped, and above all, as long as we're equipped with a friendship circle and a team around us who understand that shared value principle, who are utterly reliable. The four of us, my three business partners, we've been directors of the same company since 2002. Okay, and we've changed a company. You know, we've all left corporate life now, but we've been consistently over those 15 or 16 years co-directors, and we've seen trouble and strife. We've seen challenges. You know, we saw the market correction in 2001, where you know, the dot-com boom. And bust cycle. We've also seen the market in 2008, 2009. I mean, we sold our business in late 2007. That was great timing, but I would say it was more of a chance rather than an engineered solution. So look, we've seen how each one of us reacts differently. We know what each of us like to do. We're all prepared to roll our sleeves up and get stuck in. But we know when the chips are down that we're all prepared to do whatever it takes. And some of us are better at doing other things, you know, different things to each other. So you need to understand where you put your troops when you're under fire from a potential situation. But always be collaborative, always communicate with all the parties who are under duress in any situation. Kaz, are you and your partners similar? You appear to be wonderful with detail and highly risk aware. You're also good with people, emotionally calm. You all... Yeah, are we all emotionally calm and just interested in the nature of partnerships? We're all different as individuals. We've got about 17 kids between all of us, so none of us chose to buy a telly. But yeah, I guess we're all fairly similar. Like minds attract, but we've all got very different penchants. You know, we enjoy different parts of business, and we complement each other. If you have like-minded people all the time, then it's going to be a pretty dull business plan. You know, you need people who are open to challenge and be prepared to be challenged and to challenge. So it's quite a complex question. I could go on for forever on that one, Kaz, but hopefully that gives you some clarity. Oh, Caroline, sorry about that. So no, I won't be able to join you on that. And thank you, Irina. James, yes, we absolutely are going to do these next year. It'll be up at the original price though, yeah, probably be another week to 10 days before we release the first 6 months of a 2018 calendar. What's the best exit for an SPV after the development has been completed? Well, it depends on your strategy, it depends on the strategy of your stakeholders. Assume it's a buy, develop and sell, then the SPV would, in a controlled manner with your accountant, that would be dissolved. We don't reuse SPVs. Okay, that SPV would finish, complete, satisfy all its liabilities, and to HMRC. Ours are held as subsidiaries in a holding company structure. So hopefully that helps you there. Thank you, Jagoda. Mark raises an interesting point. We did do some development tours, Mark, but they were quite time intensive, to be honest. And the take-up was, it was about return on time invested, to be honest. So what we've now decided is our development tours in the future will be those that commit to on the masterclass, then they can come along when we go to a development. So come along with us as our friends, if you like, as our guests on a day, rather than paying to attend one of our sites and do a tour for 50 quid or whatever it is. So yes, this will be for people who do the masterclass in the future. They've then got the basic knowledge, and I think it's really important. You can't learn a lot from seeing plasterboard, but once you've had the knowledge, then it's important to see the context. So that's what we will be doing there. So that's why you'll get that complimentary day with me, or a few hours in the morning around one of our developments, and I'll show you around and put it all into context again for you. Thank you, Andy. Yeah, you're on next week's course anyway, so yeah, appreciate you got to cook the wife's dinner, so good night. Irina, yes, who are the mentors on the masterclass? Total number of participants, always under 20, generally somewhere between 15 and 18 people. We keep the masterclass very small in numbers. It's a very personal experience. I'm there, and Nigel Green is there for the 2 days, and Phil Burr is there for the second day. So Phil comes in as he's our commercial director, and he runs through a lot of the onboarding of the main contractor, the soft market testing, the pre-qualification, the bank covenant checks, the procurement strategy, the design strategy, CDM regulations, all the stuff that you need to know to keep you safe, but also how do you get on board a professional team who will manage most of that heavy lifting on your behalf. So Irina, yeah, you get myself and Nigel there for the 2 days. We don't bring in any other mentors. We're not training other people to take our place. You don't come on our course and find that actually you've got somebody who's just been doing it for 6 months, being a mentor. Nothing like that. You pay for 2 days. You pay for 2 days with me. You get it 2 days with Nigel Green, and you get a day with Phil Burr. And of course you get the evening with Nigel Green and myself, and who can say fairer than that? Nice steak or a nice vegetarian meal at the Brooklands Hotel, nice glass of wine for all, and yeah, so you get that as well. Thank you, Kaz. Thank you, Anna. Thank you, Mark. Okay, so I think that's it from everybody. Well, thank you very much for listening. I hope it's been incredibly valuable. I put a lot of time into our courses. Some of you may have been to our Discovery Days in the past. We don't do fluff and nonsense. Okay, you want the reality of learning business. We'll have some great fun along the way. I do smile from time to time, but my overriding passion is to leave you at the end of that day with a support network there, the knowledge that you can apply, and the sense of anticipation. There are very, very few questions that you can't foresee coming down the track, okay? And that will boost your confidence, your self-belief more than anything else, and enable you to go into commercial agents, accept the responsibility of putting in offers, managing the whole process with confidence. And I can see that confidence and self-belief radiating, and if you get to that point, it will become like a catalytic flywheel for you. Okay, it'll be self-perpetuating, and you'll be able to go from one development to the next and really accelerate your growth, because every one of you have got those hidden talents. They need to be nurtured, they need to be encouraged, and it's going to start with knowledge and confidence, and I can help you do that, helping people at the moment on our masterclass and mastermind. So if you can put that time aside on the 31st of October or the 1st of November and the 1st of November or the 5th and 6th of December, and put in that code equalife.co.uk/ACDM, and the code is CCF17. Then hopefully I will see you next Tuesday and Wednesday, because I know many of you are action takers. We can book up a 30-minute call with myself, and I'll help you get your strategy underway. And look, you've invested your evening. I'm hugely grateful. Thank you very much. Let me just check if we've got any more questions, because you've been very attentive. Yep, thank you, Kaz. Yeah, so that's the last question. Kaz, thank you very much. Great webinar. Brilliant. So if you've got any other questions, drop me an email. Okay, my email is mark.stokes@equagroup, EQUAGROUP.co.uk. mark.stokes@equagroup.co.uk. I'll be looking at my emails for about the next 10-15 minutes. But if you want that bargain for $897 plus VAT to attend that course over the next few days, or indeed December, then please take action this evening. I wouldn't want you to miss out on that. And thank you very much. And that's the end of the webinar. So look forward to reach out, have a chat with me. Great. Look forward to seeing you next week. And thank you very much for investing your time and putting your trust in me. It's genuinely, humbly appreciated. Thank you very much indeed. Take care.